Hi, everyone. It is 1 o'clock, so we are just about to get started. Thank you all for joining us today for this Saxo's webinar in collaboration with Amundi about aligning your investments with your values, a guide to responsible investing. My name is Ida Johannesson. I'm head of commercial ESG at Saxo, and it's my pleasure to be here with Eline Navermo, who is Deputy CEO at Amundi's Nordics. Amundi is the largest asset manager in Europe and also a global leader in responsible investing. Hi, Eileen.
Hi, thank you for having me.
Good, great. Now I'm going to share my screen. I think actually I am sharing my screen, so I'm just going to go over some of the slides here. I'm going to skip the bios. You can read them if you are interested. Today, the format of the webinar is slightly different to what we normally do. Eileen and I are sitting in the Saxo studio, and we're going to have a conversation about responsible investing. The agenda here is we're going to talk about responsible investing, the different types of responsible investments, how to identify your values and align those to your investments, how to measure the impact of your investments. I would also show you how to find and evaluate responsible investments on Saxo's platform. And lastly, we'll go over misconceptions, challenges, and the latest trends. We have time for your questions. Please feel free to add them to the chat anytime during the hour, and we will do our best to answer all your questions. If not during the presentation, then at the end. We also have a short survey. We greatly appreciate if you provide us with your feedback, as it helps us improve. The webinar is recorded, and the recording will be available on the platform tomorrow, so you can watch it on demand. Now, first, some important information. Today's webinar is for educational and informational purposes only, and not a recommendation to buy or sell any products. Investing in financial products involves risk, including the risk of loss. And as a general rule, you should only invest in products if you understand the risk associated with them. Past performance is no guarantee of future results. And before investing, you should consider your own situation, your own financial situation, your investment objectives, your time horizon, and your risk appetite. So we are about to get started, and I'm just going to ask Eileen, can you please explain to us what responsible investing is?
With pleasure. So I think looking at this slide, I think it explains it pretty well. Responsible investing is taking traditional investing and adding ESG factors. And I'm sure you've heard of ESG before, and we're going to dig into that a little bit more as well. But it's basically environmental, social, and governance factors to the analysis. And then very importantly, also adding engagement with companies, meaning that you use your power as a shareholder to try to influence positive change with these companies. And that can be through a direct dialogue with the company. So companies like Amundi will meet with companies all over the world every single day, and will, of course, have discussions with their senior management. So you can try to make a positive change face-to-face, so to speak. But you can also use your shareholder voting rights at annual general meetings and try to influence them in a positive way there. So I think that's three key elements. And as I mentioned, we'll dig into the E, S, and the G. I think you've heard of them so many times before, but maybe we should just have a little look and see what it actually entails.
So you tell me when I should change the slide.
Now you can change the slide.
Okay.
Okay, so we'll kick off with E, which stands for environment, of course. So when we talk about environmental factors within company analysis, can be governmental analysis too, but let's just say companies for the sake of it, it's easier. We look at a company just to see what their impact is on the environment, essentially. So it can be things like greenhouse gas emissions, pollution, their waste disposal, their water usage, the extent to which they use renewable energy sources instead of fossil ones, for example, the natural resources that they use, the depletion, deforestation is a big topic, of course, And I think very often when we think about environment, we think about companies that have huge factories, for example. This is sort of the traditional polluters that you think of. But if you think of IT companies, for example, I mean, they have servers and they use up enormous amounts of energy, for example. So we need to look at that energy source. So it really is something that can be applied to every single company, because even if it's a service-based companies or it's a factory-based companies, production-based companies, they all have a physical presence somewhere and they all have an impact on the environment. So that's the E factor. Let's go to the S factor, the social factor. So the social factor essentially looks at a company's influence on its employees and the society it's based in, essentially. So when we talk about employees, we talk about things like working conditions, health and safety, working hours, the benefits that the employees are given, whether these employees are part members of unions, whether they have agreements in place, how protected they are. We look at things like gender equality, how many women are there on the boards. We look at things like, potentially remuneration, etc. But it's basically also looking at the society that the company is in. Is it giving back to society, for example? Is it creating jobs, etc.? So I think the E and the S factors are quite well known. I think when we think about ESG investing, we in particular think about the E, but the S is just as important. And if we come to the G, which is the next slide, it's actually the one that has sort of existed the longest. Let's put it that way. It's the G factor, the governance factor, has always been incredibly important to asset managers, to companies, to investors, because good governance means that shareholders are being treated well, basically. So this is a factor that's been in play for a really long time, and some things that we look at is or are the independence of the board of directors. We look at the shareholder rights, at the risk management within the company, the manager remunerations that the CEO pay, for example, tax policies, fight against corruption, fight against fraud, anti-money laundering. All these things play a role in the G factor. So maybe not something that you think of when you think responsible investing, but a really, really crucial part of the analysis.
All right. Responsible investing is quite different to traditional investing. Can you tell us about the benefits of responsible investing and how those differ from traditional investing?
Well, first of all, I think it should be seen as a complement to traditional investing. So the traditional investing part is still really, really important, the financial analysis. But I think there can be one important factor is the goal that the manager has, the fund manager has when he's managing your money. So maybe the financial goal isn't the only goal, but you're actually looking at more factors. Can you exclude certain companies that you don't want to invest in? Can you maybe prefer to put your money in companies that have better ESG practices? And in some cases, it even goes so far as to say, okay, maybe financial return isn't the number one goal. So when we look at the strictest of the strictest, the impact strategies, for example, some of them are willing to forego a higher return in order to do something well, give something back to society, for example. So you have those different types of goals. And when we look at the benefits of responsible investing, I mean, there are a lot of them, but let's just go through 3 that I think are important. The first one is maybe quite obvious. I mean, risk management. So if we take an example, if you spend a lot of time analyzing the E factor at a company, for example, you may avoid financial losses through a lawsuit. Let's say this company is polluting a river, they get sued. That amount can be extremely high, and it will affect the share price. Of course, it's from a risk management perspective, it's a great tool, and that's traditionally how it started, probably for most, and maybe still is actually for most asset manager, a risk management tool. I think for you guys listening to this webinar, and I mean, this is the whole topic of the webinar. I mean, it's the alignment of your values. I think when we talk about investing, it can be a little bit boring sometimes. It can be, pick this European equity fund and not this one. But what do you associate with Europe? What do you associate with the US, etc. When we talk about ESG or responsible investing, it can be more like things that are important to you. Is the climate important to you, you can invest in net zero strategies. Is it, water or resources, or a lack of resources, or it can be water, for example. You can invest in water funds. Or is it social factors, for example, gender equality? I mean, there are a myriad of different themes, different topics within ESG investing, and I think it's a great way for investors to actually find something that they're passionate about and say, hey, this is interesting, this is cool, I prefer to put my money there. So an alignment of values for sure. And then the third one is obvious. I mean, that's the positive impact that you can have through your investment. And the impact can vary. There are varying degrees of ESG integration. It can go from very light to very, very strict. An example of sort of the strictest or the greenest, for example, is if you invest into green bonds. So I'm not sure if you've heard of green bonds, but essentially it's companies or governments or quasi-governments that raise money from investors to invest in green projects. So it can be something like, well, we would like to build a wind farm or a solar farm or whatever it is. And you can really track that money and you can see exactly where it's going to. So certainly very possible to have a real positive impact with your investments.
All right. Good to know. I actually have a question about that later, but good to know that
Great.
you can have an impact with your investments.
Mm-hmm.
I guess next we are going into the next section, which is, sorry, you're going to have to bear with me. Those slides might be a bit complicated. Yeah, so now we're going to the next section, which is about the different types of responsible investments. There are many different types of responsible investments. And by understanding the differences as an investor, you will be able to align your investments with your values. And this can also help dispel some of the misconceptions or myths about responsible investing. The main strategies are negative screening, positive screening, ESG integration, impact investing, and active ownership. Now, the first one is also the oldest form of responsible investing. Negative screening is also known as socially responsible investing, or SRI. It was started in the US, I would say back to the 18th century or so, by religious organizations that did not want to invest in certain companies or sectors, the so-called sin stocks. So it was alcohol, weapons, and tobacco. And over time, those considerations have broadened to include things like environmental considerations. Examples of companies that are excluded are oil and gas, tobacco, gambling, and weapons. So negative screening is really, in a nutshell, about excluding from your investment universe companies or sectors that are not aligned with your values, or companies or sectors that you consider detrimental to the environment and our society. I see a question here about diversification when it comes to negative screening. Well, because negative screening is about excluding sectors or companies, your investment universe actually is being limited or smaller than the broader market. So it can impact the diversification of your portfolio and even the performances of your portfolio. Some investors exclude the fund stocks from their portfolio. And we know that those companies or that sector has done really well in the past few years. So, of course, in such a case, your portfolio might have a lower performance. But it is about your choice. If you do not want to have certain companies or sectors, you choose not to invest of those. And so, of course, if the performance is different than it is expected. The second strategy is positive screening. Positive screening is about including in your portfolio companies that rate really high on ESG factors. It is not the opposite of negative screening. If you think of negative as excluding the bad, with positive, you include the good. And so you want to invest in companies that excel in ESG performance and actually set the standard or the benchmark within their industry. Examples of positive screening include best in class, momentum, and thematic investing. With best in class, you invest in companies that have the highest ESG ratings. With momentum, you invest in companies that have strong ESG performance, but also move their ratings faster than their peers. And lastly, with thematic investing, you pursue a specific theme, an ESG related theme, could be sustainable agriculture or clean energy. Now I have to click on this again. Yes, so we've covered that. Next is ESG integration. ESG integration is actually the largest responsible investment strategy. I think they represent about 50% of responsible investment, whereas negative screening is the second largest at about 25%. Integration is about incorporating ESG factors as part of your traditional financial analysis. Why do we do that? We do that to identify the risk, as Eileen was talking about earlier, identifying risks and opportunities that can impact the financial performances of the investment that you are considering to make. And then based on that assessment, you then choose to avoid or limit exposure to companies due to financial or environmental considerations. Let's say a company that could be excluded is an oil company. Now, the environmental consideration here are that we know that those companies are major polluters. They have high carbon emissions. They are harmful to the environment. So if you have environmental considerations, you would tend to avoid or limit your exposure based on those considerations. The financial considerations are the fact that the world is willing to move away, more and more away from fossil fuel. And so those companies might become obsolete. And that is a financial consideration that you should take into account. And we've seen over the years how the exposure of oil and gas has gone down, for example, in benchmarks. The S&P 500 exposure today is about 3%, whereas back in 1980 it was 30%. And so all those things are connected. There's underperformance, there's a rise of the tech sector, but there's also less interest from investors. Okay, next slide. Yes, it's very important for me to mention that ESG integration is different to negative screening. With ESG integration, you can avoid or you can choose to limit your exposure. And so an integrated strategy may well own an oil and gas company. It's more about underweighting relative to a benchmark than excluding altogether. The next strategy is impact investing. And here it's about focusing on having a positive and measurable impact on society and or the environment, alongside, of course, a financial gain. Impact investing wants to address some of the world's most pressing issues, things like climate change or poverty. And with impact investing is this concept of intentionality and additionality. And so the impact must be intentional and not happen by accident. And then the impact must be additional. Very, very important when it comes to impact investing. Examples of impact investing, you can invest, of course, in mutual funds or ETFs, but it's mostly typically project-based, private equity funds, NGOs. You could also invest in green bonds, or you could even invest in a startup company. The next strategy that I have up here is active ownership. Active ownership is not a standalone strategy per se, but more a component of responsible investing. With active ownership, you choose to engage with a company to influence the adoption or implementation of ESG policies and practices. You do that by talking with them. Either you could be in touch with the board of director of a company, you could talk to senior management, you could even contact the PR team of a company, or you could do that by exercising your voting rights at annual general meeting. And often people ask me, but can I, as a retail investor, be an active investor? And the answer is yes. Of course, the larger your stake, the more influence you can have. But even a small investor can have an influence. A few years ago, I owned Tesla shares, and I remember always voting at meetings. For example, I voted against the remuneration package for Elon Musk. I think he was over $50 billion, and I just thought it was excessive. So, of course, I voted against that proposal. And I also voted against re-electing his brother to the board of directors. I thought, total lack of independence here. I think in both cases, the resolution was passed, but it doesn't matter. I mean, I use my voice. So as an investor, especially a responsible investor, you should use your voice and be an active investor.
And if you choose not to, then if you invest, for example, in Amundi or whoever, then we'll take that voting right for you, so to speak. So the bigger the asset manager, the more collective the voice becomes, so to speak. The bigger the voice becomes, and we're certainly very, very active in these types of annual general meetings, shareholder meetings, where we try to align ourselves with our clients as well. Very often they come to us because they do like the fact that we're quite vocal and quite strict as well on many of these topics.
Exactly. And it is something that as an investor, you can actually question. You can pick up the phone or send an email to your asset manager and ask them how they handle resolution. Do they vote on your behalf? Or what is it that they intend to vote for? So, as an investor, you have the right to ask those questions. But the truth is, most investors do not do it.
No. And maybe just to, because I think it's interesting what you said, I think the reality is as well with these 5 types of investing is that very often you'll find a mix of all of them. Maybe not impact is maybe a little bit separate, but most ESG funds, I would say, probably have a mix of negative, positive, and integration for sure. So it's not one or the other. You can actually find ones that have all of them mixed in.
Yes, exactly. It can be a mix, and especially for active ownership, it's usually a component of all the previous ones. There's a question here about whether impact investing always has returns that are lower than the other ESG strategies, and the answer is no, not necessarily.
No.
Do you want to take that one?
No. I mean, I'm sure we're going to say the same thing.
Yes.
So please go ahead.
So the answer is no. Impact investing does not necessarily have lower performances. There's actually 2 types of impact investing. One is, I would say, impact first. And so if it's impact first, the investors are willing to accept a lower return. When the strategy is financial first, then investors seek a return that is a competitive risk-adjusted return, the same as the other ESG strategy or responsible strategies, and the same as the broad market. Yes. Oh, actually, yeah, we need to move back to our faces too, so you see us from time to time. So I guess the next question is about identifying how to identify values. Okay, so I guess I'll share my slides. Let's go for a mix. So identifying your personal values means that it's something that you do. It's not something that we can do for you, the asset manager or your advisor. It's something that you have to do yourself. Essentially, you need to self-reflect in order to identify the issues that matters the most to you. Do you care about the environment, or are you more into social justice? Or maybe it's corporate governance, or it could be that it's a mix of all three of those. After you've figured out the issues that matter to you the most, you need to assess your motivation. Why do you want to invest responsibly? Is it because you want to limit your risk? Eileen was talking about this at the beginning. Or is it that you want your investments not to do any harm to the environment or society? Or it could also be that you want to make a difference. Now, once you've done one, identified the key issues, two, assess your motivation, then you can align your investments with those values. And the thing here is if you want to limit your risk, you should probably invest in an ESG integrated manner. If you want to do no harm, then you could go for negative screening or positive screening. And if you want to make a difference, then you have to go for impact investing. Now, Eileen, aligning your investments with your values, that's one thing. But how easy is it for an investor to actually evaluate whether their investments make a difference or not? Is it even possible for an investor to do so?
We do have certain criteria, certain types of impact, let's say, that we can measure. And you can either go, and we will look at the Saxo trading platform in a minute. But you can go there and you can try to find information, but you can also try to go straight to your asset manager. So if you're investing in funds or ETFs, you will find documentation on that product on the platform or even on their website. It can be things like fact sheets. It can be things like annual reports, sustainability reports, etc., etc. So it requires likely a little bit more research. I think the easiest thing you can do is to go for the fact sheet. Very often, asset managers put impact measures or various types of ESG measures on their fact sheets. Unfortunately, there's no standard, so everyone is free to do a little bit what they want actually, and this, which factors they want to show. And if they want to do it as a table, as a picture, as text, whatever it is, it can be a little bit different depending on where you look. But there are certain things we can look at. So we can look at things within environment, for example. We can look at things that have to do with climate. So it can be things like CO2 emissions that have been avoided. It can be things like your carbon footprint. If we look at water, it can be things like water usage, water saved, etc. When it comes to the energy sector, of course, to what extent are we investing in fossil fuels, or is it renewable energy? What types of renewable energy? If you're looking at things like green bonds, which is down at the page, you will very often find quite detailed information about the projects that have been invested in. So, what types of renewable energy is it, for example? So that's actually quite interesting. If we look at the social factors, so by the way, you can't really measure impact in terms of governance. We really only look at environment or social. So if we look at social, it can be things like health and well-being. So the health of your employees, for example, there are various measures. It can be things like employee benefits or working hours, etc. Affordable housing. So, for example, if you invest in social bonds, which I'm sure you understand is exactly the same thing as green bonds, except that you don't invest into green projects, you invest into social projects. So it can be things like providing affordable housing. It can be things like building a hospital. It can be a lot of different things. And then, of course, we have things like gender equality. How many what's the female representation on the board, within management, et cetera, et cetera. So there are a few different factors we can look at. And I brought with me one example, so you can go to the next slide. Of the environment factor, let's put it that way. One thing that you will certainly find very often is tons of CO2 avoided emissions. You're probably thinking, okay, well, what does that mean? I have no idea what that means. It sounds good, but what does it mean? There's a small description at the bottom as well for those who would like to read along. Basically, what we talk about when we say how many emissions we have avoided. So if we invest in a green project, for example, we look at, what are the emissions that we would have had we not done the project. So, for example, if we're changing the insulation of a building, in order to ensure that they need less gas or less fossil fuels or another type of energy source to heat the building, then we've avoided emissions, right? So it can be a very it's a difficult number to grasp, and that's why I wanted to bring this example as well. So here's an example of 132 tons of CO2 avoided emissions per 1 million euro invested. So what does that mean? Well, it basically means 18 homes energy use for 1 year, 31 gasoline powered passenger vehicles driven, or 10.6 million smartphones charged. I think especially the last one we can associate with, because we certainly know how often we need to charge our phone. So that's one way of looking at it. And if you go to the next page, just to show you that this is actually real and true, this is just an example from one of our fact sheets. This is one of our green bond funds, and you can see that we do, in fact, print this number. We measure this number and we print the number of CO2 emissions avoided. So that's one of the things on the environmental pillar. And then I brought an example from us as well on the social one. So this is a fund that has a social angle. So you might not find, it might not be that all funds have this detailed level of information, but this one certainly does. So it's a little bit hard for me to read it from here, but actually I did a test yesterday and I have perfect vision. So let's try. So CEO pay ratio, what does that mean? Basically, it means how much higher is the CEO pay compared to the average worker, right? So we have the measure for the fund in dark blue and the measure for the benchmark in light blue. I'm not sure if I need to explain to you what a benchmark is, but obviously, if this is a global equity fund, for example, we tend to measure it against the MSCI World, for example. The MSCI World is the most famous benchmark. It basically is a collection of the largest companies traded worldwide in developed markets. And you can see that the ratio is certainly much, much lower than the average of the benchmark. Then you have things on the right, staff training, so the number of hours. Then you have, what does it say? Example of
Which one?
the bottom left. Oh, example of representation. I'm sorry. Yeah. So how many of the employees are actually on unions or represented by some sort of working agreement? And then you have a very classical measure on the bottom right. It's the gender equality or the gender representation. So what percentage of the board is made up of women compared to the benchmark? So these are the types of impact measurements that you can find on these types of funds.
Okay. So what is next? Let's see. Okay. So next, it's how to find and evaluate responsible investment options on Saxo's platform. My intention was to show you on the platform, but I'm afraid if I go from one screen to the other, I might run into difficulties. So I'm just going to stick to the slide, and actually copied a lot of screen shots here. So you should have everything. Now, to find and evaluate responsible investment on the platform, you can use the ESG ratings that are available on the platform for both stocks and funds. We use Sustainalytics. And so I have an example here from stocks at the top and ETFs at the bottom. You go to the market tab, you scroll down all the way. There's something called Explore Stocks, for example, and then you access the screener. So what you should do is when you access the screener, that's a little picture on the top, you should select sustainability ratings, negligible or low risk. The one below medium is average, so that's not what I'm interested in as a responsible investor. I go for top ratings, which are negligible risk and low risk, because Sustainalytics looks at the ESG risk of a company. And for the fund, you look for the sustainability rating, and you should select either 5 globes or 4 globes. The same here with three globes, that's the average, and you want something that is above average. In addition to the ratings, you can choose to do some additional research, and then I'll show you how. This was an example of a company that popped up in the list from my screen. So that is Société Générale. And then you go to the sustainability tab that is highlighted here. And there you can have access to the ESG score of the company, the environmental score, the social score, the governance score, but also the risk category. In this case, it is low at 18. And then there's a definition here or an explanation of what the rating is. It is a measure of how well a company manages material ESG risks. Actually, I looked at this company 2 days ago when I was putting the slides together, and I looked at it again yesterday. And now the score is 19. So it's really getting close to the border between low and medium. So who knows? I don't know exactly what happened to the company, but the score was changed in a matter of 2 days. So if you want to dig deeper into the company, you can go and read their sustainable disclosure. So this is the example again of Société Générale. I went to the website and I clicked on publication and document. And then I clicked on to corporate and social responsibility, which is what I was looking for. Clicking on that, there's a whole list of category, a whole category here, and a list of various documents. You can see the whole list on the right, on the climate and energy transition. When I clicked on that, I had access to 17 documents, and then I selected the one called Société Générale Decarbonization Targets and Attributed Emissions. And there, I ended up with this document here. You have all the information that, well, not all of it, but you can get access to tons of information if you're looking. And so here I was able to see, for example, for the oil and gas sector, what their targets are and where they stand vis-a-vis those targets. And you can see the baseline was 100 in 2019. The target is 50 in 2025, and then even down to 20 in 2030. And you can see the progress. So they are progressing toward their target. There was the other example with cement, and it's slightly different there because there's been no progression. They are exactly where they started in 2021. Basically, it's the same process for mutual funds and ETFs. You screen for funds using the screener, screening for the sustainability rating. And then you can see on the bottom right here, when you go to the overview of the fund, you would have access to the sustainability rating. In this case, it's 5 globes, which is the top one. And then if you click on documents, you would access what is known as the key information document or the fund's prospectus. And it's very important that you review the prospectus to find out what is their strategy or if they even have an ESG strategy. So what I did for this fund here, I clicked on the kid and then I just searched for ESG, and then you have information about their strategy. It's a passive fund, and it says here that they would invest in companies with higher environmental, social, and governance ratings, series of exclusionary and ratings-based criteria. The fund will adopt a best-in-class approach, blah, blah, blah. So you can find the information that you're looking for if you search for it. Now, we talked about the ratings, we talked about doing some research, but I think it's also very important that you don't just focus on the responsible or ESG criteria, but you look at other considerations. The quality of the company that you want to invest in, you make sure that your portfolio remains diversified. You look at the risk of the investments that you want to make, and of course, you monitor your portfolio regularly. Quality is simply that you go for companies with solid fundamentals. You have to ask yourself, is the company growing? Is the company profitable? What is the level of debt? Diversification, we always say, do not put all your eggs in one basket. Your portfolio should not all be invested in clean energy, for example. And for the risk, the same, you need to look at the volatility of your investments. How volatile are those investments? And in terms of monitoring, you monitor to ensure that it's still aligned with your values, but also your financial goals. I don't know what we have next. Let me just check. Oh, why isn't this working? Excuse me. Okay, fine. I'm just skipping through some slides here to find out. Okay, sorry. Here we go. Now we're falling into the last part of the webinar, more or less. We quickly want to cover misconceptions, challenges, and trends. So I'm going to start with the misconceptions. I think what I hear the most is about performances. There's always this idea that responsible investing has lower return than traditional investing. And the answer is that is not true. There's been tons of studies and empirical evidence and data show that it's actually not the case. Responsible investments perform just as well or even at times better than traditional investments over the long period. And so I have some examples here. Yes, 1 second, I have to click on it. I have just for you to read over. I have some examples here that show and studies that show that it's not the case that responsible investing always underperforms traditional investing. That is not the case. So
I think that the reason we've had that is, of course, since basically since Russia invaded Ukraine. First, we had an energy crisis, right? So obviously, if you exclude things like oil and gas, and then oil and gas does extremely well, then your ESG investment would underperform, of course. And then a lot of these ESG investments have excluded weapons and defense for obvious reasons. And of course, that's come back very, very strongly since the beginning of the war. So that's something to bear in mind. You know, when you exclude things and then those things that you exclude do really, really well, then yes, it could underperform. But it also means that when those things do really badly, which also happens, then you outperform. So it's just about being aware that, you know, it's not all about sort of ESG. You know, there are real economic currents, factors that influence these sectors, and they will have an influence on your investment as well. So I think it's just important to bear in mind that it will vary, and it's because you're not investing in exactly the same thing as everyone else.
exactly, and that's a good point. It will vary. At times, it might underperform, but at other times, it might outperform. The last thing I want to cover is challenges for the industry. The first one is definitely the lack of standards when we talk about frameworks, ESG disclosures, and regulations. I mean, it's just, I dare to say it is a mess. Accounting standards have standards. When we talk about US GAAP or IFRS in Europe, there's generally accepted principles. But that's not the case with ESG. And so this lack of standards mean that there's inconsistent data presentation by companies. I mean, the same company all over time, but also companies that are in different countries. It also makes it very confusing for investors to compare between companies and even interpret the data. I mean, you have to do some serious detective work as a retail investor to understand and be able to compare disclosures at times. Something else that is a big challenge for the industry is definitely greenwashing. Do you want to talk about how you address that at Amundi?
Well, I mean, an extremely, extremely, extremely important topic. And there was a big scandal involving another company a few years ago. And it was, I think, a wake-up call for a lot of asset managers. And it was certainly some, it was a chance for us to really check all our processes. We did an enormous audit, and it came back very, very good. So we had absolutely nothing that we needed to be worried about, and that's great. But of course, it's something that we need to all asset managers need to be careful with. That we are, and companies as well. That we are being transparent about what it is that an investor is getting and what he's maybe not getting. So, of course, very big topic, was especially a very big topic a few years ago. I think it's calmed down a little bit now. I think there was a chance for a lot of companies to really make sure that all the nuts and bolts are in the right place and everything's run smoothly. So I think less of an issue now, but of course continues to be very important.
I think it's definitely a big issue still for
Mm.
retail investors. They do not trust what companies disclose. And we can see also, because of the lack of standards, companies can actually choose what they disclose, and they can choose to only disclose the positive side of their effort, but not the negative side, or when they do not meet their targets. There's another issue with ESG ratings. Companies are rated by independent provider, but those providers use different methodologies, which means that the rating for the same company could be quite different. There was an MIT study recently that showed that the correlation was around zero point 0.6 for the major ESG rating providers. In contrast, the correlation for credit rating agencies is 0.99, which is almost identical. So that's a huge difference there. Lots of institutional investors use more than one rating. But of course, as a retail investor, it's a bit more difficult. At Saxo, we have Sustainalytics, but we do not show another rating. I mean, it is quite costly, so we have to take that into account. And the last challenge that I want us to cover is definitely the political backlash in the US when it comes to ESG. Do you want to say something about that?
Well, I think in the US, maybe it has been two extremes. Perhaps it went too far on one end, and now it's going way too far in the other end. I think in Europe, we've certainly always had our ethics, our values, and they've remained quite stable over time, whereas they've ebbed and flowed a bit more in the US. It's certainly been within our industry. It's certainly been a big topic, and it certainly has forced actually the hands of very many American competitors of ours to change their communication, at least around the topic of ESG, which I think is incredibly sad. And I consider ourselves very fortunate to be a European company where that is not the case, and we can proudly say we're staying our course, and we won't change the way we invest responsibly because of political pressure from the US. But it's certainly very different when you're based in the US.
Yep, we definitely see that. I think last year, because of the political backlash and the pressure, we've seen some funds outflow because of the opposition from some politicians in Washington. They've rolled back a number of laws in the US, ESG friendly laws, DEI initiatives, quite strongly. And so, yes, but even in the face of all this political backlash, I mean, climate change is not going away. So the future is not rosy. It's not easy. And we need to address those challenges. But we need to also deal with those issues. They're not going to disappear just because of the next president or the next leader in whatever country.
Quite the opposite, probably.
Yes, at least that's how I see it. We have, I believe, we're reaching the end of our presentation. So we're going to turn to you and your questions. So we're just going to read whatever we have here and then answer some of those questions. Let me scroll here. Oh, yes. Sorry. I forgot one thing that we should cover, that Eileen should cover today. And I actually wanted to ask her because she's working for the largest asset manager in Europe. What are the trends that you see at Amundi with responsible investing?
Well, I think when it comes to responsible investing, it's certainly in many countries the interest has sort of gone down a little bit from the peaks that we had in 2021. Where we had Greta Thunberg and Fridays for Future and all that. The the climate agenda was extremely topical, and it was every day in the newspapers, etc. And then the war came, and all of a sudden it was about other things. So when it comes to trends, we certainly see that, maybe in some regions it has gone down a little bit, but it certainly remains very, very strong in the Nordics still. Amongst institutional investors, it also remains quite strong. And it's because of the things that you just described. These problems are not going away. The risk management side of investment is still there. So it's a little bit the retail interest that has gone down in the last few years. But I really do believe that it will return. So now we're focused on, the war here in Europe, but also in Israel and Gaza, where, we're worried about defense. And one day that will calm down, hopefully. And then I think we will shift our attention back to the climate because it's not gone away. The problem has probably been exacerbated, if anything. So I think that will come back. And we do see a trend towards sort of net zero transition, where, you're not just excluding bad companies, so to speak, but where you're actually trying to change them in a positive way to maybe shift away from fossil fuels to more renewables, etc. That's certainly still there. And then we also see quite a lot of growth in the real asset space. So now, through the LTIF that you may have heard of, also the retail market is moving into to a position where they're able to invest into real assets. And within the space, as you mentioned as well, you can find quite interesting ESG projects, impact projects, et cetera, et cetera. So I think the real asset side will see some revolution, some developments within the ESG space. So I think there are pockets where there's still a lot of growth and a lot of interest. Certainly on the thematic side as well, there's interest. But I think overall we'll get that wave back into ESG when things normalize a little bit.
Okay, glad you reminded me to cover that part. Okay, so now back to the questions. I'm just going to go through those. Jaffles is asking, considering the state of things with regards to some companies, for example, SAP, rolling back their DEI efforts to follow US rules, how is this being reflected in the ESG ratings and by when? I think I can take that one. I talked about the Société Générale example earlier, where from one day not the next, but 2 days later, I could see a change in the rating. Now, it all depends on the cycle or the schedule of the provider, but those changes are reflected pretty quickly. But one thing to remember also is that the DEI efforts are part of the S, and so the score for the S might change a lot, but maybe not for the other factors. And so it doesn't mean necessarily that a company would move from a low risk to a medium or high risk. It all depends on the magnitude of the change.
Yeah.
Anything you want to
Completely
add to
agree.
that?
No, perfect.
Okay. Somebody is asking, no, not somebody, Vikus is asking how to identify companies with good ESG ratings.
That's an excellent question. So actually, MSCI has a website that is completely free. You can actually go in and check it out. So you can find companies with good ESG ratings. However, I also assume that on the Saxo platform, there is information about that. I think we even looked at that before, didn't we? You can see the scores, the ES and the G scores of various companies on the Saxo platform as well. So yeah. I think it's quite easy these days. It's much easier than it was a few years ago, for sure. So I think most trading platforms will have some sort of information on ESG with ESG ratings. And it can be different things. I mean, it can be a score from sort of 1 to 10. We at Amundi, for example, we use letters. We use letters from A to G, where A is the best, G is the worst. So it can be different things. But it's certainly quite kind of easy to find these days, I would say.
All right. There's a question here from Elise. I think it's probably because you talked about a benchmark earlier. She's asking, how is the benchmark determined?
So how easy they're determined?
The benchmark for a strategy.
Yeah. How is it determined?
Yeah. How is it selected? Why do you pick this benchmark?
Yes, that's an excellent question, actually. So what you want to do is you want to find a benchmark that has the biggest alignment with what you're trying to do within your fund. So let's say we're doing a global equity strategy. It has nothing to do with ESG. it's just we pick the 50 best stocks in the world, you will probably go for something like MSCI World. So just something plain and simple. And then let's say we want to do something that's super strict in terms of ESG. Then we might go for the MSCI World SRI. So
Yes.
what you want is basically you want to be as close as possible to the benchmark. So you don't want to have, like, let's say we're doing a super strict SRI strategy where we're excluding 500 companies. It's just an example. And then those 500 companies are in the benchmark. And then you will have these huge performance differences that have nothing to do with, the stock picking ability of the manager, but it's just the index composition. Those are the things you want to avoid. So you try to get that match.
We have another question here from Elisha. Is the MSCI World SRI considered diversified enough to have close to broad market returns?
I would say yes.
I would say yes
Yeah,
also.
I would say yes.
Yes.
Yeah.
Next, Elise, another question from Elise asking any recommendations on ETF or funds that invest responsibly? She's saying that she doesn't have a lot of time to look for those on the Saxo platform. We do not provide any recommendations, but on the platform, you have access to a number of investment themes in the ESG section of the platform, where we list ETFs and mutual funds that have top ESG ratings.
It's a good tip.
Guru, let me read the question. What is the risk of greenwashing, helping companies artificially boost their ESG scores to pass these filters? Are there fund managers who actively research further to the legitimacy of their ESG traits?
Oh, yeah, of course. That's an excellent question, actually. So, this is the whole point around active management, obviously. So the company will provide a report, of course, and they're very helpful. But usually that report is created after the end of a calendar year, and it usually takes about 6 months, right? So a company XYZ will produce a CSR report for the year 2024, and it'll come out now, for example, and it'll say about all the things they did, and that's great. However, we speak to them much more often than that, and we might take the report from last year and then be like, okay, well, what are the improvements? Can you prove that you have done these things? What have you done, during the course of the year? You mentioned in your report back then that you were going to do this and this and this in this year. Have you done that? So of course, certainly, and that doesn't just apply to ESG. It also applies to normal financial reports. We always challenge the companies on their numbers. So certainly that's something that takes place within active management. Yeah.
Actually, one thing before we go to the probably next and last question, I just pull up the QR code for the webinar. If you could please scan this code and answer 6 short questions about today's webinar and just provide us with your feedback. And so we're going to go to the next question from Elisha. When ESG ratings improve over time, do funds and ETFs automatically adopt these improvements?
Yes, I would say yes. It's so if you look at an ETF, right? An ETF is passively managed and it's built up. It copies an index, right? So we talked about the index. Now the index is made up of companies, and these companies have ESG ratings, and then the index provider decides, the weighting, for example, of those companies, and they will certainly take the ESG rating changes into consideration. So that's the short answer to that. But that, of course, also applies to active management. But when it comes to active management, and you alluded to that before, is that usually you don't just use one provider, you usually use several. So Amundi, for example, uses over 15 different ones. So it can be that one updates a rating and the other one doesn't, and you just have to look at the different data and why are they different? Why does this one think that way? Why does this one think that way? And then we have our own analyst, of course. So I think on the active side, it's probably a little bit quicker. But the answer is it certainly gets implemented for sure.
All right. It's 1:59, so we're just going to go for one last question. How do you buy green bonds?
Well, you buy green bonds exactly the same way you would buy a standard bond. So they can be found on whatever trading platform you use. Now, it can be, as a private investor, can be quite difficult to buy single bonds because they tend to be, they have nominal values that are very high. So you might need, I don't know, 200,000 euros or something just to buy a bond. So it could be quite difficult. But you can certainly buy a green bond fund or a green bond ETF with a euro, so.
Yes,
Yeah.
definitely. You can buy some ETFs or funds, and some of them are available on our platform.
Mhm.
I checked before the webinar. So thank you very much, everyone, for joining us today. Thank
Great
you,
questions.
Eline, for
Yeah.
your time
Yeah.
and your insights. It's been a pleasure.
Likewise.
The recording would be available on the platform tomorrow, as I said. Answer those questions in the survey if you have a few minutes left, and hope to see you soon.